There we are. We've hit 40, so let's kick it off. Hi all, a very warm welcome to today's event, hosted by the CFA Society VBA Netherlands. My name is Kees Harm van den Berg. I'm a board member and the treasurer for the society. I'm also a senior strategist at APG Asset Management. Our new and very dynamic Quant Committee, chaired by Bob Jansen, has worked with Dimensional Fund Advisors to organize 2 webinars, one today and one on April 1st, and that's no joke. During today's webinar, we will dive into the perspective on the premium in equities. First of all, a little bit about Dimensional. Dimensional is one of the leading firms in systematic investing in equities and fixed income. And the 2 events will focus on their research into return drivers in equities. We will also touch upon important practical considerations for investors wanting to pursue the premiums that are associated with those return drivers. I'm very happy that both webinars will be moderated by Dusan van Leeuwen, who leads Dimensional's team across the Benelux and Nordic regions. Dusan joined Dimensional in, I think, 2012, if I'm correct. And some of our members may know him from his role at Dimensional or from his previous career in equity brokerage and research, where he was his last function was head of equity research at ABN AMRO. Dusan is actually joining us from his Dimensional Amsterdam office, which is a luxury. I don't think a lot of people can attend from an office, most from their home office, which is similar to mine. So I'm using a background because the laundry is in the back. Dusan will introduce Wai Dai. She's their senior researcher who will present today. Just a small, some housekeeping remarks. Please note that the meeting will be recorded, so keep your video off and also mute your microphone. And at the end of the session, there will be room for Q&A. So please post your questions in the chat so we can raise them to our speakers. That's it from me. Thanks very much. Over to you, Dusan. You're still on mute, Dusan.
I've been doing this for a year and I still get it wrong. I've made that joke more than once, so it is as bad as it seems. Dankjewel Kees Harm voor de introductie en goedemiddag or good afternoon to all viewers. Thank you for taking the time to join today's webinar, and thank you to the CFA Society VBA Netherlands, specifically to the members of the Quant Committee, for organizing those 2 webinars with Dimensional on the topic of factor investing in equities. My name is Dusan van Leeuwen, and I'm a regional director in Dimensional's global client group. I am indeed speaking to you from our Amsterdam office, properly isolated and socially distant, so hopefully safe. And it is a luxury to be here, especially the bike ride every morning and afternoon is a real refresher for me. Now, I'm sure that many of today's viewers already know Dimensional, perhaps even know me. I saw a few familiar names in the group today, but I would like to take just a few minutes to offer a bit of context and introduce our firm as well as today's speaker. Dimensional will be celebrating its 40th anniversary next month, and since April of 1981, we have been working to put the very best ideas in finance to work for clients in live strategies across equity and fixed income, with some forays into asset classes like REITs and commodities. For those best ideas, we look primarily to research. Since the start of our firm, we've worked with leading academic researchers, including several Nobel laureates, and our in-house research team is around 100 strong. Dimensional is a systematic manager. This means that our research efforts are aimed at identifying systematic differences in expected returns and also seeking effective ways to incorporate such differences into our investment processes. The objective is always to build strategies with higher expected returns, after costs, of course, to have proper risk monitoring and risk management, and also perhaps to integrate other objectives, for example, sustainability objectives. In equities, which is where we will focus in our 2 webinars, we are often classified in the domain of quant or factor investors, which is fine, although we prefer to label ourselves systematic. What we want to do today is to share our perspective on premiums that matter within equities. We will provide the framework that we use to identify premiums that it makes sense to incorporate in the design of strategies. And we will also talk about some of the research that we've done into other premiums that are often part of our conversations with investors, specifically the momentum premium and also low vol. Finally, we will talk about the investment experience that many users of systematic equity strategies will have had over the last years, and I'm of course referring primarily to the manifestation of the value premium. We will share some high-level research observations and talk about how the behavior of the premiums, which research informs us about, drives how we may pursue those premiums in our equity strategies. I hope that sounds like a good agenda for today. And before I introduce today's presenter, let me just go back to what Kees Harm said about asking questions. The way to do that is indeed through the chat function, and it would be helpful if you would direct your question to me so I can monitor those questions and either weave them into the conversation as we go along or move them to the end of the session where we have room for Q&A. With that, let me take just a moment to introduce Wei Dai. She will do all the hard work today. Wei is a senior researcher and a wonderful colleague, and she's joining us today from her family home in Singapore. Wei joined Dimensional in 2014, and she has since published papers on both equity and fixed income topics. She also spends much time with Dimensional's clients and prospects across the EMEA and Asia Pacific regions. Prior to joining Dimensional, Wei has earned mathematics and applied mathematics degrees from her native China. She also has a PhD from Princeton in statistics from the Department of Operations Research and Financial Engineering. Welcome, Wei, and good evening to you in Singapore.
Yeah, good afternoon, everyone.
Let's start conversationally, Wei. I'm sure you're going to dig into the good stuff really quickly, but let's get some of those semantics out of the way first and tell us, do you have a preference when you talk about this stuff to use words like either factor or premium or dimension? Where does your heart lie?
That sounds like a good question for me because I can be very particular when I write papers, try to be as precise as possible. But I would say for today's discussion, as long as the context is clear, you'll probably hear me using those words interchangeably. It's more just referring to systematic drivers of expected returns. And yeah, I don't have a strong preference.
Great. That makes our life a little bit easier, perhaps, for this conversation. I'm going to ask you to take over from here, share your slides, and dive into the presentation on perspectives on premiums within equities.
Absolutely. And thanks again, everyone, for joining us today. The backdrop for today's discussion is really the increasing interest we see and also a lot of significant asset moving into systematic space, moving into systematic strategies, which as Dusan already introduced, something we have been doing for almost 40 years. So it's good to see that the world is moving in our direction. And I think it makes a lot of sense for a lot of asset owners, because if you do systematic strategies right, you kind of get the best of both worlds. Just like indexing, you're getting that high diversification, low turnover, low expense ratios, and also low monitoring costs from the investor perspective. But at the same time, you're not settling for market return. You're still, just like traditional actives, trying to outperform the market, trying to pursue higher expected returns, but doing so in a more systematic and scalable way. So I think that all sounds good. The natural question then is, what does it mean to do it right? How do you assess different systematic managers out there? I would argue that at least there are two important aspects. One is you need to have solid research to underpin the systematic strategies, and you need expert implementation to actually translate those research insights into real-world portfolios. I think this is quite analogous to thinking about cooking a good meal. You need fresh ingredients and a good recipe on one hand, but you also need a master chef to actually execute it. Of course, whenever my husband tries a new recipe and fails, he always blames the recipe and I always blame his cooking skills. So I guess both of us could have a little bit more balanced view of the world. So hopefully today, through my presentation, I could give you a little bit more balanced idea. I will certainly focus on our research and thinking about the framework for expected return, how we research into the behavior of the premiums. But at multiple places, I will try to hint on the implications for implementation as well. So we'll start with the framework for expected return. And it's important to have a framework even before you look at data, because with so much machine readable data out there, with so many people incentivized to find patterns in the data, I would say that finding something that works in the historical data isn't that hard. And but our goal is not just to explain what's happening in the historical data. We want to find things that can benefit our investors going forward. So I think there, in order not to chase just spurious patterns in the data you happen to find in the historical data, it's helpful to have a framework to guide your research, to help you develop your hypothesis, to have a prior which variables should be related to expected returns even before you look at data. And the framework we use is a very straightforward one. Essentially, we're saying, well, if you look at the price today of a security, look at its market value, what does that represent? Well, it represents the expected future cash flows that you're entitled to as a shareholder. And those happen in the future, so you're discounting them back to today's value. And that discount rate from our investors' perspective will be our expected return. So essentially what we're trying to say is that how do we get a higher expected return? And through this framework, it certainly says the expected return is related to the price you pay, that's on one hand, and the expected future cash flows that you receive. And then from that, you can see how do we get a higher expected return? Well, by paying less in combination with by expecting more, right? More higher cash flows. So I think through this framework, you can see that it's helpful to combine price-based metrics with cash flow related metrics. One way to think about it is, well, certainly when you do investing, price matters, but price is only one side of the coin. Because if you observe an investment to have a low price, well, that could mean that the discount rate is high, so higher expected return. But it could also mean that the expected future cash flows are low, right? So that's all like what people often refer to as value trap. So by having a proxy or some information about expected future cash flows, then you can make your price variables more informative. So that's how, by using future cash flows, that's a nice complement the price metric that you use in order to assess differences in expected returns. I think this is quite analogous to Warren Buffett's quote that it's far better to buy a wonderful company at a fair price than buying a fair company at a wonderful price. So that really shows the importance of not only looking at prices, but also looking at cash flow related information. So that kind of leads us to the premiums that we consider as the core or the main drivers that we use in our portfolio design. And these are the size, value, and profitability. So you can think of company size and relative price as the price metrics, right? Because you can't just compare companies by, say, price per share. That doesn't mean anything. So you need to normalize prices. So one way to do that is to say, well, let's look at price times shares outstanding. That gives you the company size. So smaller cap companies should have higher expected returns than large cap companies. And you can also divide price by, say, some fundamental variables, say price to book. That gives you a relative price metric. So lower relative price companies, like value firms, should have higher expected returns than those with higher relative price firms, the growth firms. So that's the relative price dimension or the value premium associated with that. So those are the two price-related metrics. And then profitability will be the other side of the coin when we talk about expected future cash flows. Of course, because future cash flows happen in the future, so not directly observable, unlike price today. So what research found is that if you look at today's profitability, that gives you a lot of information about future profitability. In particular, if you look at the cross-section, the firms with higher profitability today also tend to have higher profitability in the future. So that way you can use the current profitability as a proxy to get this information about the expected future cash flows. And firms with higher profitability should have higher expected returns than firms with lower profitability, all else equal. So I think this gives you a sense of why we think that these premiums make sense, because they all fit nicely together under this valuation framework. And then after that, that's where we can go into the data to see whether the empirical evidence supports the prediction of the valuation framework. And then where also empirical evidence comes in, the research is that you also need to understand, how big those premiums have been, how volatile those premiums are, what's the interactions between these premiums, because all of those about the behavior of the premiums can inform your portfolio design and management. So let me start with some real data to give you a sense of, okay, over the longest periods possible, when we get our hands dirty with as much data as possible, what are the things we find? So we'll start with just the US large cap universe going back to the 1960s. And every month we are going to sort security from top to bottom, growth to value, and from left to right, low profitability to high profitability. And the cells you see shows the average monthly returns of those stocks in the intersections of those two sorts. So essentially we can start with, there are lots of numbers, so just to orient ourselves, we can probably start with the diagonal. You can see that if you think about the valuation equation, the prediction is that if you move from higher price, so growth firms, low profitability, so the top left corner, to the bottom right corner, so value firms, high profitability, that's the direction of higher expected returns. And indeed, you see that borne out in the data as well. In terms of the average returns, we see that's increasing from the growth, low profitability firms to value, high profitability firms. And that's true not only just for the US, but also developed ex-US, emerging markets within US small cap as well. And since we only have, like a 2D slide, so it's a lot harder to show all three dimensions together. So the way to see the size premium then is by comparing the US large grids versus the US small grids. So you can see that the positive size premium once you control for value and profitability. So this gives us a good sense of how you can also design your portfolios. Let's imagine if you want to say buy a emerging markets all cap portfolio. Then what you can do is to say, let's buy all the securities in the universe, but let's put a little bit more weight towards the lower right corner. So you can overweight those stocks with basically higher returns. Those are higher profitability and valuer and also smaller cap. And underweight those stocks that are larger cap, growthier, and lower profitability. But you could also say, well, maybe I'm only interested in a developed market solution and only value. That's what I'm interested in terms of part of my asset allocation. Well, that's also fine. You can say, well, now let me buy just the value sleeve. But then within that universe, you can see that, for example, here within the same value bucket, if you sort between from low profitability to high profitability, there's still a return spread. Right, so meaning that these premiums exist in the continuum, and depending on the segment that you're interested in, you can determine your universe, and then within that, you can still make considerations about size, value, and profitability in order to increase expected returns. So I think that's really the nice thing about being a systematic strategy, because the approach can be very consistent and can be highly customizable, really depending on the universe you're interested in, and also how much tilt or how much deviation you're comfortable with relative to the market. Now, I think
may I introduce you just for a second? I have two questions that came in. One is
absolutely.
that on the profitability dimension that you mentioned, we're using current profitability, so essentially a backward-looking metric. How does that take into account the idea that some companies grow faster than others?
That's a wonderful question. I think that actually touches on very much an ongoing research we have, where we're certainly doing research to say, well, if we can say something about profitability growth, meaning looking at today's profitability and tomorrow's profitability, and can we say something about that growth? And what we have seen in our preliminary results is that the profitability growth, so if you look at past growth versus future growth, that also tends to be persistent. So we may be able to actually use systematically the observable data to enhance our profitability metric. So that could be a very exciting enhancement down the road. For now, we're using the current profitability. I will say that in terms of the research results, we do see that there is reliable information about current profitability, about future profitability. It's almost like thinking, tall parents have tall kids. That's something quite intrinsic. It's not going to work for every single family or every, many generations down the road, but it is a systematic relation that you can rely on in a broadly diversified strategy. Of course, I will add one thing is that you also don't want to use profitability numbers just at face value. So maybe there are, especially when it relates to COVID-19, we see companies are taking some impairments on long-lived assets, and many of those can be one-time, maybe just extraordinary or one-time in nature. So those are the things you actually need human oversight to account for, so that you do get a metric that's more persistent and also getting you more information about the future. That's probably more than what you need, but I do like the question about profitability. So, Dusan, you said there's another question?
Yeah, the other question is very much about adjustments and human oversights, and I think I know what your answer is going to be, because it's about intangibles. I'm sure you'll smile at that. The question is, do growth companies tend to have low tangible assets but high intangible assets, and does it make sense to incorporate that sort of information in your process? I'll give you a chance to respond.
Yeah, well, it's another research project that we spent a lot of time on. Actually, I would say we will do a deep dive into intangibles in our session on April the 1st. But the short story is that when you think about intangibles, there are two types of intangibles. There are the external acquired intangibles that you get from buying another company. Those are already reflected in the book value and therefore reflected in the metrics that we use. So it's not true that say, oh, these metrics just ignore intangibles. But then, of course, there's also internally developed intangibles, and those things are kind of the costs are expensed. So they are, not part kind of capitalized on your balance sheet. So we've done a lot of research into that. First of all, we don't really see a dramatic increase in internally developed intangibles once we estimate that number. And then we see, what we also see is that once we try to adjust our price to book ratio and also profitability by the internal intangibles, we don't really see that enhances our ability to pursue higher expected returns. So certainly stay tuned if you're interested in that research.
Absolutely. Highly recommended to tune in again in 2 weeks on the 1st of April. There are some other questions that have come in already, Wei, but in the interest of time, I'm going to let you continue here and maybe group some of those questions and ask them to you later. Thank you.
Yeah. So here, I'm showing you all the long-term averages. So of course, we know that these premiums can be volatile, and over different periods, you'll get a different snapshot. So I will talk a lot about the volatility of premiums in the second part of the talk. But before that, I will address a few other premiums, because I feel this framework can be quite useful for assessing other premiums out there. And the example we'll use, I think Dusan already told you, that is low volatility. I think it's a premium that's getting a lot of attention and also probably some renewed debate on this one. So in terms of low volatility, let's start with the obvious. Why have low volatility strategies got attracted so much attention? I think it's mainly because of this. So what I'm showing here, these teal dots are volatility portfolios. So every month we're sorting stocks based on their past volatility, or here based on beta. You get very similar results. I'm going to use beta and volatility somewhat interchangeably throughout. So essentially, you're sorting stocks from low vol to high vol. So here you have the low volatility stocks, and here you have the high volatility stocks. And what you observe is that indeed, if you look at their monthly volatility, the high volatility stocks indeed have much higher volatility than low volatility stocks. But what's interesting is their returns, which you see is somewhat a flat line. If anything, it's the low volatility stocks that are actually delivering a little bit higher returns. So I think that's really what has made low volatility stock strategies very appealing to people, meaning that you are reducing the overall volatility of the portfolio, but not at the expense of lower returns. That sounds pretty good, right? But here, note that here I'm showing you a particular sample period, which is post 1970. You could go back further and if you go back further, starting from look at the 40 years prior to 1970, you see a very different picture. So now, again, sorting from low volatility to high volatility, you see that now the thing is, the pattern maybe potentially is a little bit less surprising, meaning that lower volatility stocks now have lower returns and higher volatility stocks on average have higher returns. So I think then the question becomes, why these two very different patterns? And what should be our expectation going forward? I think here you really want to understand what's really driving these return patterns. And the framework we talk about, these known drivers of expected returns, size, value, profitability, and so on, can be quite helpful for answering this question. So if I move on to that assessment, essentially what we do here is to look at the low volatility bucket, so just the bottom bucket, and run the regression and regress the returns of the low volatility stocks on either the 3 factors, so market size and value factors, or the 5 factors, so including also profitability and investments. So these are the known drivers of expected returns. And what you tend to see is that over the period, so the post-1970 period, where you see low volatility stocks delivering market-like returns, those stocks actually have a pretty decent dose of the value exposure based on the 3 factor, and also if you look at 5 factor value, prof, and investment. So meaning that because of the exposure to these known drivers of expected returns, and because those premiums do deliver positive, because of that boost, low volatility stocks have had better returns than it otherwise should without such emphasis on these premiums. And after controlling for these premiums, you see that there isn't so much abnormal return per se left, and the T statistics associated with these intercepts, so meaning the returns that's left is also quite small. So meaning that after controlling for, so meaning that the low volatility stock returns over the post-70 period can be well explained by the premiums that we already know. So that means if something is only a repackaging of old stuff, or think about some old wine in a new bottle, it's not really going to enhance your ability to pursue higher expected returns. And as a result, we don't really think of that as a separate return driver for that reason.
Wei, before you make your next point, because I think I know where you're going, if you could go back just one slide. There is a question that came in, which is, why did we cut these samples in half at the 1970 breakpoint?
1970. Well, I think that's actually where you see most of the low vol literature's focuses on. I think that's if you cut the sample this way, you see that that's where you see more pronounced kind of outperformance on low volatility stocks, or the fact that the low volatility stocks delivering market-like returns. But in the 40 years prior, it's not the case. So it's a great question. I think whenever you read papers, it's often helpful to ask why this particular sample period. If it's not the full period, if there's not a particular reason, why focusing on certain period? And then if you look into the post-70 period, you actually see that it's kind of, there are 2 stretches where the low vol stocks tend to have a bigger a value tilt. And then that have really driven the performance of those stocks.
Thank you, Wei.
Yeah. And just to graphically kind of illustrate that, in here I'm only focusing on the value coefficients, but I think that helps to already illustrate the point. Essentially, if you go from the low volatility stocks to high volatility stocks, you see that the value coefficient, so the exposure to value, goes from positive for low vol to negative to high vol, right? So low volatility stocks behave like value stocks, and high volatility stocks behave like growth stocks during this period. Again, the post-70 period that Dusan you just asked me about. However, if you look at the prior 40 years, it's not the same case. So as a result, you're also seeing very different return patterns. And then I think to really answer my question earlier, what it should be our expectation going forward. Well, I don't have a strong prior to say why low volatility stocks or high volatility stocks should have a consistent focus on certain premiums. I think they may get you the indirect exposure to those premiums, but that could be arbitrary. It can be time varying. So if you want to have value and profitability exposure, we think the best way and the most effective way to do so is to design your portfolio directly focusing on those premiums. And if you want to purchase low vol strategies, I don't think the expectation should be that, yes, we will get, because without the systematic focus on those sources of expected returns, we don't think they should have market-like or even higher expected returns. I think that has been our messaging for many years. Our first low vol paper was published back in 2014, I think. And these results we've also updated through 2020. You see very similar findings. So for us, and we actually do manage such strategies for clients. If you want to control your overall volatility of your equity portfolio, yes, certainly you can filter the universe based on volatility because volatility tends to be persistent. So you can start from a lower volatility subset of the universe. That's totally fine. But you shouldn't have that expectation that that should give you higher expected returns or even market-like returns. But within that universe, we think that you can still tilt towards size, value, and profitability. So you can still increase the expected returns relative to that starting universe, which may have lower expected returns relative to the market.
Wei, one final question. I don't want to slow you down too much, but a lot is coming in and it's much appreciated. Do you know, I don't know this by heart, to be honest, if we've looked into the link between returns on low vol strategies and interest rates regimes? Specifically, has this anomaly, I'm doing the quotation mark thing with my fingers here, has this anomaly been related to specifically times of low or even falling interest rates?
I don't have something on top of my mind that's specifically about low vol versus interest rate, but we have looked at a lot about equity returns and interest rate. And essentially, if you think back to the valuation equation, I guess I'll give you my prior first, is that if you think about interest rate changes, that could change the discount rate that's in the denominator, but it could also change your expected future cash flows that's in the numerator, right? And these things can be offsetting each other. So what the final results will be, I think it's really a empirical question. And what we have looked at are kind of overall market return relative to interest rate changes or the different premiums, size, value, profitability premiums relative to interest rate changes, and different sector returns relative to interest rate changes. We haven't seen any reliable relation between the two, meaning that even if you have the perfect foresight of interest rate changes where interest rates are going, it's not really helpful for you to predict the premiums or sector returns or overall market returns. So for that, I am skeptical that it will be reliably kind of telling you something about low vol returns, but certainly something we can take a look.
Thank you, Wei.
So we've talked a lot about size, value, profitability premiums and how to use that to assess other premiums out there. I think that's really about the main drivers that we use to design our portfolios. But I do want to say that in our daily management of portfolios, we do consider other variables as well, which tend to give you information about shorter term expected returns, meaning maybe differences in expected returns in the next few days to next few months. So just to kind of extend the framework a little bit and give you the complete story, we've talked about size, value, profitability. These are what we consider the long-term drivers. So if you think about a value stock, it's going to be in the value portfolio for 4 to 5 years. So that leads to pretty low turnover, 20-25%, even without any turnover mitigation. So those are the ones that drive our long-term asset allocation in the portfolio. But then there are also variables that tell you something about shorter term. So the returns next day, next month, and the next quarter. So I think a good example of that is momentum. And I think it's a good example showing that because these premiums are relevant for different time frames, you want to treat them differently. You don't want to simply say, well, with all the variables, let's just combine them into one and then treat them the same. So I will use momentum as an example to show that not only the variables, which variables you use matters, how you use those variables is equally important. I think that really already hints at the implementation part. And also this framework, intraday is more related to how we trade the securities. We actually spend a lot of time on the research into the microstructure of the markets, try to get our best execution done. And so I think with this framework, you can also see the importance of having a daily process, because you want a process to move as fast as your information does. And that way you can effectively use those short-term drivers, as well as being more consistently focused on the long-term drivers, because prices change every day. So I'll use momentum quickly as an example. I think momentum is just the idea that stocks that have outperformed their peers tend to outperform in the near future. And here you're looking at the stocks that are identified as up momentum, so that they have outperformed their peers in different markets. And then you kind of track their returns over time after identifying them as up momentum stocks. And you see that there is a pretty sizable return spread in the first month, but the return spreads start to decay very quickly. So I'll say about 6 to 9 months into after the portfolio formation, you no longer see a return spread relative to the market. And the same thing applies to downward momentum stocks, right? That negative premium also tends to dissipate very quickly. So the natural question is, well, that means you will really need to incur a lot of turnover and costs if your strategy is to directly chase momentum, right? Basically design your portfolios based on the momentum signal. Can you actually do it in the real world, right? The paper portfolio may look great, but what about the real world? And for that, we actually looked into the real world funds out there who have momentum in their name and who have a positive and sizable momentum coefficient, meaning that these are the funds that we believe are the ones that are actually trying to capture momentum premium directly. And what you see, these are just fund A to N. For compliance reason, you cannot see the actual names, but these are the real funds out there trying to directly chase momentum. And I will just draw your attention to the last two columns. So the second to last column shows the momentum premium essentially on paper, right? Over the life of each fund, how big has the momentum premium been? And there have been plenty of periods when the momentum premiums have been pretty positive. Now the last column then shows what's the real world results. This here we're simply just comparing to the market. And yes, you see some funds outperform, the vast majority of them didn't even outperform the market. I think this is just really giving us a pause that maybe the high turnover of strategies may incur a lot of high costs and that end up eroding the premiums. That seems to be consistent with our prior. So then what can you do about it, right? If you don't directly chase momentum, how do you incorporate momentum into your process? And here's how we do it. What we do is what we call momentum screen, meaning that instead of directly chasing and buying and selling based on the momentum signal, we're using that as a way to delay the buy and sell. So I'll give you an example. Let's say stock A and B. Both are now value stocks, and then we want to buy more of in our strategy. But stock A has the downward momentum and is expected to also continue to underperform, at least on average, over the near term. But stock B doesn't have downward momentum. So on this particular day, we may say, well, let's buy B instead of A, and on next day, we can evaluate it again. The reason we can do that is because we hold broadly diversified portfolios and we care about really the overall characteristics of those securities instead of individual names. So we have a lot of A and Bs to choose from. And the other thing is because we have the daily process. So today we can evaluate A and B. Maybe tomorrow the downward momentum kind of signal dissipates for A, then we can start buying that. So I think this is a way of us trying to get exposure to the momentum premium without incurring additional turnover and cost. And what's the effect of that? Here is an simulation that trying to kind of keep all else equal, but only with momentum and versus without momentum. And these are the all cap simulations across different markets. And you see a difference on the order of 10 to 30 basis points per year. And we think these are meaningful numbers and showing that, yes, you could actually get, you can benefit from momentum premium if you do that in a thoughtful way. So I hope this is a good example showing you that not only which factors you use matters, but also you really want to think about how the manager is using different factors. And then we've done a lot of research into the behavior of these premiums, and that has informed our implementation over time. So now we've talked a lot about, I would say, expected return, right? These premiums. But we all know that as investors, you're getting the realized returns. And the realized returns have two parts, the expected part and the unexpected part. And oftentimes, the unexpected part will drive a lot of the news and a lot of the stories. So I think for us, kind of thinking about pursuing these premiums, understanding the volatility of the premiums, understanding that especially over the short term, a lot of things can be driven by unexpected, news unfolding and changing expectations. I think that's really a helpful place to start. And this will apply to all the premiums we talk about. But as Dusan said, I think value is probably on top of everyone's mind. So we'll use value as an example. So just to illustrate the volatility of the premiums, here I'm showing just the calendar year realizations of the value premium, showing on average you see a value premium about 4.5%, but there is a huge range. I know that my statistics professor often reminds us that you should not only just look at the mean, but also the entire distribution. And he used to say, remember, my head is in the freezer, my feet are in the oven, but on average, I feel just fine. So I think this really shows that the average can mask a lot of the volatility of the series. So looking at how much you may be actually outperforming and underperforming on any given year is a helpful way to inform your expectation. So here you can see that although on average the calendar year value premium is about 4%, the range is pretty huge. And if you just look at those positive years, there are plenty of them, the average premium in those positive years is about 3 times bigger, so it's 13 to 14 percentage points. But then you also see these white bars. These are the times when the premiums actually underperform. And I think these are other periods that can be very disappointing for investors, but it's already part of the game, meaning that if all these bars are always positive, you may wonder why you should be getting a premium to begin with. But it's helpful to form the expectation. How frequently would you see a negative premium? I think here we have some numbers that may be helpful to inform that expectation. So here, if I focus on value, and we're looking at these rolling 1 year, 5 year, and 10 year periods, and see how frequently do you see a negative premium. And you look at even over a 10-year period, you see 1 in 6, so about 17% of chance you will see a negative premium. And that's actually on par with what you see with the market premium. About 15% of chance of those rolling periods, you actually see a negative market premium, meaning the equity market actually underperforming just 1 month T-bills. Of course, we all know that this is not going to change our expectation that the equity, by investing in equities, you should be compensated with higher expected returns than holding 1 month T-bills. But still, there is a chance of underperforming even over a 10-year period. So now it becomes more a portfolio design and management question. What can you do to mitigate the impact of these underperformance? What can you do to increase your odds of success? I think one thing that's already clear from this chart is that to have a long-term focus, because if you look at from 1 year to 10 years, your probability of outperformance increases, right? Your probability of realizing negative premiums, it decreases as the longer that horizon that you have. The other thing I think is helpful is to integrate multiple premiums. And here we're showing that if you look at market size, value, and profitability premiums, and again, over 10-year periods, it's actually not uncommon to see one premium being negative, about half of the chance. Of course, the one that's underperforming will get the most attention. But if you look at 2 negative premiums at the same time, that percentage is a lot lower. And a 3 and 4, much, much lower. Meaning that because these premiums don't move in lockstep, by integrating multiple premiums in the portfolio can help increase your reliability of outperformance. We've talked a lot about 10 years. I do want to spend a little bit of time on just the last 10 years. The way I think about the last 10 years, especially the value premium, is actually to break that into a 7-year and a 3-year, and I'll explain why. So here, if you look at the long term, you see that yes, value, which is shown in teal, and the growth shown in yellow, there is a healthy value premium about 4 percentage points. But if you now look at the first 7 years of the most recent 10 years, now you see that the value stocks on the absolute basis actually performed a little bit better than historical average, but growth stocks have done so much better than their historical average. And then the return difference at the premium is slightly negative. But now if you look at the last 3 years of that 10 years, now you see a dramatically different pattern. And then that's, I think that the 3 years is driving a lot of that those 10 years number as well, where you see value underperforming growth by 20 percentage points on an annualized basis. So that compounded for 3 years is a huge number. And just to drive that point home, if you sort all the 3-year periods, so rolling 3-year periods from 1920s, so there are 1,000 bars here, each representing one of the 3 years, and look at the value premium. The most recent 3-year is at the very, very left end. So that's the worst that we have seen. So I would say that when I look at this, I would say, well, that's the exception, not the rule. It's just like if I were to observe a positive premium to the very right end, that's not going to change my expected kind of expectation that now the value premium should suddenly be much, much bigger. Because we know that the range of outcome can be so great. And there are times that you will observe observations that's more towards the extreme ends. I think one analogy we often say, I often use is that if you think about the importance of education, I think we all agree that education is important, and many of us benefit a lot from that. But you may also run into or know of people who have been very, very successful without a college degree, right? With maybe dropping out of even high school. But that doesn't mean that all of a sudden we should all throw our diplomas out of a window. I think if you think about the validity of the valuation equation, meaning that the price you pay matters, and the lower price you pay, controlling for expected cash flows, should give you higher expected returns. I think that insight is as evergreen and as valid today as 10 years ago. Of course, I think whenever there is extreme underperformance, like what we have seen just on that chart, people want to explain why, right? People want to understand what is going on. And then there are many, many different stories associated with those. And I would say value is probably one of the topics that we spend most of the time on in recent years, doing a lot of research, because we understand people's concerns and we want to be across the recent developments and making sure we are doing the best thing ever, possible for our investors. So some of the stories that people talk about relates to the measurement of value. Maybe instead of using price to book, you should use price to earnings or price to cash flows, or maybe the intangibles that we already talked about. But there, we've done a lot of research, and I'm going to go do a deep dive on April the 1st. And then you see that, yes, maybe in the last 10 years, just by doing some adjustment and moving you away from the value and a little bit into profitability, yes, you will increase the returns. But if you do a deeper dive, it's not really increasing your ability to pursue higher expected returns. So so it's tempting to adopt a fix, but it's not the right thing to do based on our research. And similar things when it comes to the sector treatment, we've also done a lot of research, and we don't see that as a reliable driver of expected return. And I think there are also lots of questions about, well, is there a way to time these really negative outcomes for the premiums? And we've done a lot of work on timing of the premiums, either using, say, the valuation ratios or the past performance of the premiums. What we see is that it's not like you cannot find any timing strategies that worked. Actually, I think there was one that's based on some moving average with particular parameters that can reliably time the Italian value premium. However, that's one strategy and the one best strategy out of 780 that we have looked at. So when you look at the vast majority of the strategies, the timing strategies, they all underperform a buying and holding strategy. So I think this is just showing that when you look at the big picture, the opportunity cost of missing out on these premiums can be pretty high, and that we really don't see compelling evidence of being able to time these premiums. And then lastly, I think there's a lot of kind of considerations about being interest rate being low. I think we already talked about that. Maybe the market is concentrated in big tech stocks, different business cycles. I'm happy to go into any of the topics, maybe in the Q&A if there's time and interest. But I would say that there's a lot of narratives out there, but if you go into the data and try to see if that holds water, we don't see much evidence. So I know I went very quickly through these value stories, but just want to show that we have a lot of research that we're happy to share. And I will end the presentation with one more story. And this is a story of a value investor back in early 2000. So imagine we have a value investor back in March 2000, and he's looking at the performance of value stocks that's showing teal versus the performance of growth stocks showing in yellow. And over all of these trading periods ending in 2000, March 2000. And you see all the yellow bars are actually higher than the teal bars. So growth have done so well relative to value. If you look at the 10-year periods, the value premium was negative 3 percentage points. So that has been very disappointing period for investors who are pursuing value. However, if we fast forward just 1 year, you see a completely different picture. Now, all the teal bars are above the yellow bars. So for all the trading periods, the value premium is positive. What happened in that 1 year? Value outperformed by almost 50 percentage points. And because of that outperformance, even over the 2 10-year periods, remember the negative 3%, now turned to a positive 5 percentage points. And this just shows that how quickly these premiums can turn around and can materialize. And oftentimes when the premiums show up, they show up big and in bunches. And I can certainly see dimensional in that story because we kind of started our dedicated value strategies in the early 1990s. And we have gone through some rough patches, some ups and downs. And then after 2001, I think everyone thinks that we're genius in the market. But what we did was to stay consistent, they focus on the premiums. So this is not to say that this 2000-2001 period is identical to what we are going through. I think every period has its own uniqueness, and the market and the economy is always evolving. But it is a good and a telling example to show that how quickly these premiums can materialize. And we have actually seen similar episodes in recent periods. I think it's a welcoming development for people who have been consistently focused on value. So if you look at as of end of February, the 6-month performance, large value outperformed large growth by almost 14 percentage points, and small value outperformed large growth by more than 40 percentage points. So I think these periods are good periods for investors to actually assess managers to see when these premiums show up, are the managers actually delivering those outperformance? Are the managers actually capturing those positive premiums? Because as we said earlier, even for managers who are pursuing similar premiums out there, the outcomes can still be drastically different depending on how you're implementing things. So if what I said, any of the things sound interesting to you, if you want to know a little bit more about the strategies and how we actually implement, I know my colleague Dusan and myself will be more than happy to engage in further discussions.
Absolutely, Wei. I promised the society that I would not do any marketing today, so I'm really glad that you did that for me. I won't do any more. We're heading up towards 3:30 Dutch time, getting to the end of today's session. We have covered almost all the questions that came in. I would urge any of the viewers to use my email address now on screen to reach out. One question was asked about whether or not we would prefer to have a single security that is exposed to all the premiums that you mentioned at the beginning, size, value, profitability, or do it some different way. I'm going to use that as a shameless plug once more for our presentation of the 1st of April, because then Wei Dai is going to do a deep dive into other research topics. We've already mentioned the intangibles topic. We've already also mentioned the value metric topic. And the third topic that we'll cover in 2 weeks is based on a very recent paper that Dimensional has published, which is about what I'll call multi-factor portfolio construction. And the question that paper tries to answer is, what are the key differentiators between an approach that integrates those different premiums that are being pursued versus various types of strategies that combine different portfolios in order to, in the overall exposure, target those multiple premiums. I think the answer to that question, if you will, is reasonably predictable given the way that that Dimensional invests, which is not to say that our research defends what we do. We do what we do because of the research, and that's a very different approach, and I wanted to make that emphasis. At the end of our session, Wei, a huge thanks to you. You certainly fulfilled my promise that you were going to do all the hard work. I'm looking forward to our session in 2 weeks. I also want to thank all the viewers and those that have asked questions. Feel free to use that email address on screen if you want to continue the conversation. And of course, we do hope that you'll join us again in 2 weeks, hopefully on the idea that we didn't waste your time over the last hour or so. With that, Kees Harm, I want to hand back to you, and thank you again for hosting.
Dusan, thank you very much. I'm very pleased to hear that I don't have to throw my CFA diploma away or my value portfolio. So happy to hear. Dusan, thanks also for the great cliffhanger towards the April 1st webinar. Really looking forward to that session. Besides this, I really want to thank the Quant Committee as well for organizing this event. Thanks, Wei, for your very interesting presentation. I know I've done a couple of smart beta 1.0, 2.0 events a couple of years ago. I think we're already at smart beta 9.0 or something. So very interested to hear a very good talk, and looking forward to April 1st. Thank you very much. And that's the end of the session. Thanks all.